It's a very personal story. Personal because, as you can guess, I'm an immigrant originally. And coming to the United States some 28, 30 years ago, the government is not there to tell you that you have overpaid them in taxes. That's not the government's job. It's your tax advisor's job to use the tax code as a tool and not as a trap. I tell entrepreneurs that I really wonder why people even cheat on their tax returns because there is no need to do that. Like I said, the tax code really just gives you an entire roadmap. The wealthy don't take their tax figure on the face value. They work with frameworks, they strategize, and that is how they get more wealthy because the more money you can keep for yourself, the more quickly you can invest even more, get to your financial freedom. Look at the code as a tool, not as a trap.
Michael Uadiale joins me here today. You can learn what his team is up to and how they can help you with your taxes. Head over to SMADCPA.com. That's going to be a clickable link in the show notes.
It's my pleasure to be here also.
So, can you tell us a little about your journey into taxes of all things? I mean, talking about an exciting adventure, I'm sure.
It's a very personal story. Personal because, as you can guess, I'm an immigrant originally. And coming to the United States some 28, 30 years ago, I found myself working a very, very great job and got some lots of stock options. And I was new. I just passed my CPA test. But I just didn't understand all the rules of the game. So I actually hired a CPA to advise and guide me and do my tax returns. At the end of the tax year, he said to me I owed some 5 digits figure in taxes. So that really kept me thinking. I'm like, if I went and I paid all this money to a CPA who is supposed to be a tax expert, and this is the end result I got out of it, I said to myself, okay, I am going to have to be an expert in this. That was how I started the journey. I did work a lot in corporate America, but I think at a point I said I needed to begin to bring value to people because I could see there was just a high need. There's just a whole huge proportion of our profession that sticks to compliance work, not really doing proactive planning. So that's how I got into taxes. That's my niche.
Yeah, it's kind of one of those weird things. Like when it comes to tax preparers, financial planners, I put a number of bankers, professions in here, and it's really hard to find somebody that will. I don't know, maybe it's perceived as sticking out their neck to help you strategize a little bit.
Yeah. Well, I think our profession, when I use the word, I'm talking of the tax and accounting profession, needs to do some aggressive overhaul, especially given what AI is bringing into the workplace. Accountants really need to transform themselves from just being compliance oriented to becoming more proactive planners because really no entrepreneur is very excited on how complete your tax return is. What they desire is you being able to save them legally, ethically, and morally on taxes. I mean, the government is not there to tell you that you have overpaid them in taxes. That's not the government's job. It's your tax advisor's job to use the tax code as a tool and not as a trap to help the business owner, the entrepreneur, the taxpayer get to the place that keeps them asleep at night and be sure that there is nothing to worry about if an IRS audit. But I kind of feel like many people in our profession are not they are not very sure or really know who they are supposed to be representing. It's almost like most people in my profession think they are there to protect the Internal Revenue Service interest, which is not exactly the case. Your constituent is your taxpayer. So whatever you do has to be what serves your taxpayer's interest most, not to just run through the IRS website and tell me what I can do and what I cannot do.
Hmm. You're basically laying out a big shift in a mindset that you're probably telling some of your peers that they need to reposition themselves. Do you find that it's kind of swimming upstream on some of that?
Yeah, you could say that, but honestly, I kind of feel like at this point in my career, that's part of my mission. Seriously, I feel like as a profession, we need to make ourselves more relevant. We have the equity of trust. Most people will trust their CPAs with a lot of data and information, which they will not share with any of their other advisors. So it's so important that we in turn provide significant value to our clients by reason of that equity of trust that is bestowed on us. And again, I've been in the profession now for 18 years, clean record. My point there is not to do anything that is risky or speculative and all of that. Those are two different things. I tell entrepreneurs that I really wonder why people even cheat on their tax returns, because there is no need to do that. Like I said, the tax code really just gives you an entire roadmap and framework of how to bring yourself to a zero tax level if you truly understand what to do, right? So, and I really want to see more and more people who come into the profession have that mindset in terms of how they interact with their clients and serve the clients.
Let's talk about, I saw that you have an acronym, DECIDE Tax Reduction Framework. Could you talk a little bit about that and break that down? And does that coincide with this zero tax strategy that you were just chatting about?
Absolutely. I'm happy to do that. So, like I said, when I look at the entire tax code, the tax code is more like a roadmap to me. So that's why I came up with that acronym of DECIDE. The D stands for deduction. And primarily in my mind, for any business owner or taxpayer who is an entrepreneur, that should be your baseline, meaning you must be able to understand every of the possible deductions that you are legally and ethically. Do not take the home office deduction.
I'm sorry, Michael, you broke up there right when you started to describe D.
Oh, okay. Yeah, I was saying the D stands for deduction, right? That to me is the baseline. The baseline from the perspective of a business owner or an entrepreneur, you must be able to know all of the things that you can rightfully deduct. Okay. I'll give you some very basic examples. Even to this day, many years later, when I mean years later, because the home office example that I'm talking about now, home office has been a well-established deduction since 1987, right? But you will still find CPAs who will discourage their clients from taking the home office deduction because they consider it aggressive. Now, if you are a great swimmer, swimming in the 6 feet end or 8 feet end of the pool is not aggressive. In fact, you want to swim there. If you don't know how to swim, you want to stay on the 2 feet end. So I feel like a lot of people in our profession, instead of kind of going deep and really mastering what the code is saying, they tend to just want to stay away and discourage their clients. So deductions is what the D stands for. If you truly maximize all of your deductions, that is going to help you shave anywhere from 20 to 40% of what your current tax bill is. Okay. I mean, yesterday I was speaking to a dentist who has never done cost segregation study on her office building that she bought since 2011. And I asked her why she has not done a study on it. Here was her answer to me. And then CPA said, it's not worth it. So I decided to break it down for her. And I'm like, why would that person tell you it's not worth it when it was going to save you $54,000 in taxes, right? So deductions is a big piece. The E stands for the entities. How you do business, it's very important. Now, there's a huge difference between legal entities and tax entities. Most people set up their LLC because their uncle or their cousin set up an LLC. That's all great for legal protection purposes. How your entity files taxes is something that you as a taxpayer must be very much involved with your tax advisor to be able to really minimize your taxes. You can form an LLC and you have the flexibility, for example, of telling the Internal Revenue Service you want your LLC to file taxes as a C Corp, or file taxes as an S Corp, or file taxes as a partnership, or even file taxes as a single member LLC. So the entity is the second component there, which is the E. The C stands for two things. It stands for credits and income conversion. I love credits because it's so powerful. I mean, a credit in most cases, you're going to find it's 4 times more powerful than a deduction. Why is that? The reason for that is a credit literally is the government paying your tax bill. It's a dollar for dollar reduction on your taxes. So it's important to know your line of business, know the available credits that are in that industry, and be able to really tap into it. One of the things I found out early in my career is that the government uses taxation as an incentive to drive behavior for the economy. I mean, you just look at the bill that was just passed. What came out of it? The government is trying to push some things. And what they've done is to use tax incentive. So now they've brought back some very big things like bonus depreciation, increasing Section 179 and all that stuff. The idea is if we're going to make America great again on the economic side, important to give huge benefits to people who are willing to do their factories out here. So those are very important things. So that's the C. The C stands for credit. Now the I, an interesting one, that's the one that stands for income conversion, right? Now, when you have a business owner, you as a taxpayer need to look at the totality of the taxpayer's profile. What I mean by that is, who is this taxpayer? I'll give a very good common example. You can have a business owner have some kids between, say, the ages of 7 to 15 or whatever. Now, you could hire those kids in the business owner's business, right? And shift some income to that kid. Now, the parent could be at a 37 tax bracket, but when you shift some income down to the kids, maybe the maximum you want to put on them, they get to be at 12%. Either way, the family in totality now have an arbitrage of almost 25% in savings in taxes. So that's what the I stands for, which is income shift. Some people will call it tax bracket management. You got to be able to know how to manage tax bracket and bring your client's taxes down. That's what the I is. Then the fifth one is the D, which is deferral. There are many ways you can defer taxes. People do the easiest and common one, which is their 401k, but there are lots of tools which you can use to defer taxes. And again, timing is important. The wealthy don't take their tax figure on the face value. They work with frameworks, they strategize, and that is how they get more wealthy, because the more money you can keep for yourself, the more quickly you can invest even more, get to your financial freedom. So, and the last one is elimination. Now, elimination is great. There are many things that really are tax-free. A good example within the tax code will be something like your section 1202, which is qualified small business stock. What does that say? All that is saying to you is if you qualify, or if you are in an industry that is within that code and you have original shares in that business for 5 years or more, if you choose to sell that business whenever you sell it, there is zero capital gains tax that you have to pay. So there are many things like that are within the tax code that really makes the tax code a roadmap. And that's why I always say, look at the code as a tool, not as a trap. I think there's just this mindset that has been reinforced over time, where people just see the tax code as the government trying to get money out of you, right? And that has been reinforced and reinforced. And so there is this love-hate relationship between business owners, especially, and taxes. They only want to look at it or address it when it's April 15th. If you truly embrace it and get yourself educated, what the tax code can be for you is It's one of your key ways to get wealthy or get rich faster than most people will.
Well, we're going to dive into the real estate investing aspect of this here in a second. But before we do, I want to remind everybody you can find Michael and his team at SMEDCPA.com. That's going to be a clickable link in the show notes. Hey, this show only grows if you share it with another investor friend. So consider doing that. And if you're watching us on YouTube, give us a like and subscribe and feed that algorithm. So, Michael, before we get into the real estate aspect, I wanted to kind of hit on a couple things that you pointed out. One of them was the home office deduction. That was a pretty shocking number that you said there, that it can have that type of impact. I haven't been doing this, like this home office deduction. And I actually have a dedicated room for this podcast, what I do every single day. It's my commute. I come down and I have this room in the
Yep.
house. What do I tell my tax preparer to start taking advantage of this type of thing? Or what do I have to put together regarding documentation? Or what do I need there to take
So,
advantage of that piece?
so that's easy. Seriously, it's easy because what does the law say? Like I said, the law on home office has been even simplified since 2017. Okay. And what the law pretty much is saying is if you are to use a part of your home as a home office, one, there has to be what we call regular use. Regular use of a space in your home has been defined by tax court cases as no less than, say, 10 hours a week.
Well, I
One,
achieve that. That's not a
right.
problem.
Now, the second thing is, okay, it's exclusive use. Exclusive mean it's not a mixed use space. Meaning, for example, it shouldn't be a space where you have a couch where your cousin comes and crash into during Thanksgiving, right? So
Yep.
that space is exclusively for home office use, right?
Yep.
And
Yep.
then it is used if, for example, you have a main office. Use myself as an example. We have three brick and mortar offices. Now, in those three office locations, I have offices in two of them. Do I have home office? Absolutely. I work more from my home office, right? So
Right.
somebody will argue with a dentist and say you have a place where you practice dentistry. That is true. But the dentist can still have a home office where he or she does her administrative stuff. So those really, by and large, are the three things that will qualify you for a home office deduction. Now, the home office is a gift that keeps giving because it will allow you to increase your auto deduction. It will allow you to qualify to make many of your travels even 100% deductible. So those are the kind of things that makes me say my profession needs to become more transformational in the approach to work.
And then you talked about this income shift, with the kids. Can you do an income shift with your spouse? So let's say they don't have like a 9 to 5 themselves. Is that a possibility?
That's not necessary. You don't need to do an income shift with your spouse. The reason being, in most cases, you and your spouse will be filing tax returns.
Okay.
But if you use your kids as an example, then it becomes a little bit more powerful for you because if you take, let's say, you have your 10-year-old child, right? Here,
Mhm.
especially you have an home office. That child is doing work for you, whatever you are allocating to the person in the home, right? And then you pay
Mhm.
that child, say, up to $15,000 in a year. Now, why did I use the word $15,000? Because that's the amount by which, if that may not even gets to use the $15,000 standard deduction, so they can even actually get a zero taxable income. Now, what does that do for you as a family? You have 15,000 going through your business enterprise as a deductible legal expense. You are paying your child. I really consider it as a great way to increase our kids' work ethics very early in life because you're making that child truly learn how to really make money or earn money from their efforts. Plus, what is that doing for you? Literally, the government is subsidizing the basketball, the music, and all that lesson, which anyway you are paying for. Now you are giving the child a salary, income shifting, even with ownership of shares in a business, right? If you have a parent who all that parent is getting is Social Security, you could give that parent some percentage shareholding in the business because your parents is at a lower tax bracket because he or she is not making a lot of income, right?
Mhm.
And that is very beneficial for taxes. When it's time to pay the taxes for him or her, you give them the money to pay those taxes. But you know what? You give yourself quite some arbitrage in your tax reduction.
The 15,000 a year is,
Refrain.
it's kind of the magic 15, right?
Yes.
15,000 a year is the magic number. And then you would encourage that. That's the money you would use to pay for their sports and essentially have the kid pay for those type of activities.
Absolutely. Absolutely. In fact, just so 15,000 is not per se the magic number. It's the magic number for people who prefer not to have their kids be filing tax return that early. I have some clients who pay their kids 20, 30,000 a year. The first 15,000, for example, is not taxable. The next 15,000 is going to be paying taxes at 10%. Now, the parent on the other side is already at the highest marginal tax bracket of 37%. So when you look at it as a family, there's an arbitrage of 27% savings on that figure, whatever it is that the child is getting paid.
Let's jump into real estate now. I've
Sure.
seen you mention that that is a tax, I think you call it a tax-free wealth machine. How do you leverage your real estate, especially your investments, into your tax-free wealth machine?
I mean, have you ever wondered why real estate is really a go-to for most people? It is so because it's a way to really generate passive income. But what makes it most powerful is the fact that our tax code is so written that the real estate guys really have lots of tax benefit. Now, real estate is one space, one industry where if you are a real estate investor, you could just find yourself going on and on in every year, and you are putting yourself in a position where you'll be ending up paying close to zero tax every year. And the reason for that is what I call the magic of depreciation. So let's break that down. Let's kind of unpack that for your listeners. Let's say you choose to buy a real estate that is worth 500,000, right? And you put a down payment of 100,000. And then you go to the bank to get a loan for 400,000. Now, you as a real estate investor, you have basis in $500,000 assets. The bank gets the interest income that you pay to them. But for you as the investor, you get the benefit of being able to depreciate the building. Unfortunately, a lot of accountants have not done a great job advising their real estate clients. What is going on? Most clients are just doing what I call the lazy way of depreciation, meaning, yeah, you buy a property and then you put it in the market for rent and you depreciating it over 21.5 years. The right way to depreciate your property is to first of all do a cost segregation on that property. So instead of just saying, here is the $400,000 that this building is worth minus the land of say 100,000, cost engineer will do a study. And when they do that study, they will break that property into 4 classes. The law allows you to write off with this new bill anything that is going to have an asset life of 20 years and below, to write it off in the year of purchase. So think about it. Now you've put 100,000 into this building. When you do a cost study on that property, I guarantee you are most likely going to get up to 200,000 of assets that can be depreciated in 1 year. What would that do for you? If you are a real estate professional, it puts you in a position where that property has paid for itself in a while. That gives you more cash flow to go do another deal. Next year, that new deal that you do, it gives you again that same powerful tax benefit. So you just continue the velocity of that same cycle. So that's why real estate is so powerful. And I am really so excited with this new tax bill because what have they done? They made bonus depreciation 100% permanently. Okay? What we had with the 2017 tax law, bonus depreciation was there up to 2022, and then it started going down. It was supposed to phase out by the end of 2026. But what they've not done is to make it permanent. So for people in the real estate space, this is a great time for them to truly go out there and begin to increase their portfolio, knowing that they are growing their wealth and at the same time they get a tax benefit from it.
Well, this has just been such a great conversation, Michael. Before we jump into the rapid fire question and close out this episode, I was hoping you could give everybody one thing that they should probably do today to be in a better position for their taxes. Do you have any direct advice that they can implement right now?
Yes. My direct advice is simple. Find a good tax advisor. Sit down with a good tax advisor like right now and plan out how to maximize and leverage the use of this new bill that came out just last month so that your taxes is not a surprise number come April 15th. That would be my one advice.
Do you have anything else that we should have hit on that we might have missed?
I don't think so. I think we kind of talk mostly on taxes, which is the thing I'm most passionate about. I will be doing a webinar today just to really break down the new tax bill. Apologize, I don't know the code to join because I don't do the marketing. But for those who want to, they can go into our website and put in their information and we'll email them a recording of that webinar because there will be a free gift I'll be giving out there.
Well, if you're ready, sir, we'll jump into the rapid fire and close out this episode.
Absolutely.
What lie do real estate investors often tell themselves?
There are no good deals out there to close on.
Okay. If you could go back in time and give your younger self a piece of advice, what would it be?
I think I will spend more time thinking through anything than just doing it. Let me break that down a little bit for you. One of my clients once said to me, Michael, I will spend more time thinking through how I'm going to design an app before I start coding. But most people are just so much in a hurry to go coding instead of thinking through it. I mean, 18 years into the practice as a CPA, I'm sure my first 5 years was not very impactful because I didn't think through that.
Do you have a book recommendation or what are you reading right now?
I am reading a very great book right now. It's called Amp It Up by Frank Slootman. He's the CEO of Snowflakes. It's a really great book and I recommend it for any business owner.
And finally, what process or tool have you implemented that has had the biggest time-saving impact?
That's a simple one. AI is magic. I mean, really right now, I have AI tools that are close to the productivity of 2 full-time employees.
Yeah. Well, that's going to be leads into my selfless plug here. If you are looking into getting into AI or automation or how we can help you scale your real estate investing without adding headcount, head over to realdealcrew.com. We can help you with some of that and happy to jump on a quick call. But again, we were talking to Michael with SMADCPA.com. Definitely take a look at the website and how they could possibly help you strategize around your real estate investing, but more importantly, preparing your taxes. Really appreciate your time, Michael. This was fantastic. I hope you'll consider coming back again sometime.
My mission is to preach the fact that taxes is a tool and it's not a trap. Okay, that's my mission.